Welcome to this explainer. I am absolutely thrilled we're doing this today because we are officially gearing up for the 2026 Fringe Benefits Tax season. It's wild, but we literally see accountants, bookkeepers, and business owners making the exact same FBT mistakes year after year. So my primary goal today? To help you shift from just reactive tax filing to proactive tax planning. We're going to master the top 13 FBT traps together so you can actually keep more money in your business, right where it belongs.
Okay, let's dive into this. There's this incredibly dangerous misconception out there, and honestly, it's arguably the single most costly myth in the entire tax world. It goes like this. If it's a business expense, there's no FBT. We need to completely shatter this right out of the gate. The ATO, the Australian Taxation Office, regularly uncovers all sorts of benefits given to employees where the employer never even thought about FBT simply because, well, it just felt like a normal business cost. Relying on that assumption? It's a trap that bleeds businesses dry year after year.
And just to put into perspective why getting this wrong is so incredibly costly, I really want you to think about this number, 47%. Yep, 47. That is the current FBT rate for the 2025 to 2026 FBT year. If you fall into one of the traps we're looking at today, you aren't just paying some tiny administrative penalty. No way. You are paying a massive 47% tax on the grossed up value of the benefit. The financial stakes here are, frankly, exceptionally high.
So, the absolutely crucial point here is that FBT is an entirely separate tax system. It's like a different universe. FBT rules operate completely independently from your standard income tax and GST rules. Just because something is an income tax deduction for your business absolutely does not mean it's automatically FBT exempt. You really have to train yourself to evaluate your expenses through a totally different lens.
To keep us perfectly organized and make sure we cover everything efficiently, here's our roadmap for today's explainer. We've mapped out these 13 FBT traps into 5 logical groups. We'll do basics and myths, vehicles, financial perks, daily operations, and finally, how to survive an ATO audit. Let's get right to it.
Section 1. FBT Basics and Common Myths. The foundation. So, at its core, a fringe benefit happens whenever an employer provides a benefit to an employee, a director, or their associate, quote, in respect of employment. Now that in respect of employment part, that's key. It doesn't matter if it's a physical item, a financial perk, or a service. If it's tied to their employment, FBT is potentially on the table.
Moving on to Section 2, Vehicles, EVs, and Transit, the drive time traps. This brings us to the absolute most common FBT category out there, vehicles. Whether we're talking about a company-owned car, a leased vehicle, or a novated lease arrangement, the very second it's made available for private use, you're stepping right into our first major danger zone. The core trap here catches company directors off guard every single year. We constantly hear directors defend themselves, saying things like, "But I only use the ute for work." But look, here's the hard reality. Picture an auditor casually driving past your neighborhood. If that company vehicle is parked in your home driveway overnight, the ATO generally considers it available for private use. It literally doesn't matter if you didn't drive it an inch. Garaging it at home triggers FBT, completely regardless of your actual daily driving habits. The ATO targets this so aggressively, specifically looking for home garaging, missing logbooks, and incorrect odometer records. Now, obviously, with the massive rise of electric vehicles, we do have some fantastic new exemptions, but, and it's a big but, they come with their own entirely new set of traps. You cannot just assume every EV is automatically exempt. You absolutely must run through this compliance checklist. You've got to check the specific vehicle type, verify the first held date, ensure you're under the luxury car tax threshold, and very closely check those transitional rules. That last step is super vital right now, mostly because plug-in hybrid electric vehicles, or PHEVs, are generally no longer eligible after recent legislative changes, well, unless those specific transitional rules still apply to you.
Beyond the actual vehicles themselves, we also have broader transit traps. CBD parking and airline transport benefits can be absolute hidden landmines. Providing free CBD parking for your staff? That's a highly scrutinized and widely misunderstood trap. Employers often just kind of assume no FBT applies, but ATO scrutiny in metropolitan areas is aggressively increasing. And hey, if you're an industry providing discounted airline flights, a slightly incorrect valuation of those travel benefits can create a completely unexpected and honestly substantial liability.
All right, let's move to Section 3, Financial and Living Perks, Money and Mortgages, and see how this builds. These are the benefits tied to loans, housing, and staff relocation. And let me tell you, businesses get these wrong all the time.
Take LAHAFA, for example, which stands for Living Away from Home Allowance.
This applies when employees temporarily relocate for work. But the massive trap here is treating a permanent or long-term relocation like a temporary LAHAFA arrangement. In the eyes of the ATO, these are entirely different things. Missing the strict documentation requirements you need to actually prove it's a temporary living arrangement is a huge red flag, and the ATO audits these setups frequently.
But relocation isn't the only financial trap. We have 3 rapid-fire pitfalls you absolutely must avoid here. First, missing benchmark interest on loans. You have to charge the statutory interest rate, or guess what? It becomes a fringe benefit. Second, casually writing off an employee's debt. This isn't just some fun, easy accounting adjustment, it's a taxable benefit. And third, assuming employer-provided housing in industries like mining or agriculture is just automatically exempt. It rarely is. There are strict, super specific conditions you have to meet to claim those housing exemptions.
Okay, Section 4. Expenses, entertainment, and residuals, the daily operations. We're now shifting gears to the day-to-day perks and reimbursements. These are the little things that just so easily slip through the cracks during the daily grind of running a business.
When you're looking at expense payment benefits, stuff like paying for an employee's private school fees, covering their personal phone bills, or reimbursing personal travel subscriptions, you should really always ask yourself this direct, rhetorical question. Would the employee have personally paid this if the employer didn't? If the answer is yes, you almost certainly have an FBT issue on your hands. You cannot just code these reimbursements directly to business expenses in your software and pretend you didn't just provide a fringe benefit.
And this brilliantly illustrates how incredibly complex the overlap gets with entertainment, board, and property benefits. Think about things like staff Christmas parties, client lunches involving your team, sporting events, or regular board meals for remote workers. Treating these simply as tax deductions without even calculating FBT is a massive audit trigger. Remember what we talked about earlier? The income tax treatment, the GST treatment, and the FBT treatment can all be completely, 100% different for these exact same items.
Which brings us to this incredibly dangerous assumption. We constantly hear business owners and honestly even some bookkeepers thinking, well, it's not a car and it's not a direct expense reimbursement, so there's no FBT, right? Wrong. Very, very wrong.
Debunking that myth brings us to the residual benefits category. Think of this as the ATO's ultimate catch-all net. If you provide gym memberships, ongoing parking arrangements, club memberships, or specialized entertainment packages, these fall perfectly into this residual net. Dismissing them just because they don't fit neatly into the other 12 categories is pretty much a surefire way to get penalized.
Finally, Section 5, surviving an ATO audit, the climax. So what actually happens when the ATO comes knocking? Let's raise the stakes here and look at exactly what an auditor is actively searching for right now as we head into the 2026 season.
Here is pure gold on your screen. The top 10 ATO FBT review traps. Listen, if an auditor walked into your business tomorrow, this right here is their hit list. They're looking squarely at director vehicles parked at home, missing or expired logbooks, messy employee reimbursements, and entertainment expenses. If you have any of the 10 items on this list on your books, knowing the rules inside and out and having meticulous documentation is your absolute strongest defense. To help you defend against that list, I want to empower you with a proactive checklist, because your role isn't just to prepare the FBT return after the fact, it's to identify these benefits before the FBT year even ends on March 31st. Look at your accounts right now. Review those motor vehicle usage logs, audit the entertainment expense accounts, meticulously check over employee reimbursements, scrutinize any general employee benefits, and thoroughly investigate all director transactions before you lodge.
I want to leave you with this provocative final question to really think about. Will you do a small review today or face a significant FBT assessment tomorrow? The choice is entirely yours. But trust me, the absolute best FBT planning happens during the year, not scrambling frantically after it's over. Thank you so much for joining me for this explainer. Keep this slide deck handy, apply it to your day-to-day operations, and I'll see you next time as we continue to unlock the complex world of tax and accounting.